Okay, I think we're ready to get started. Welcome to this webinar on pass-through expenses, also known as expense reconciliations. Today's discussion is going to present the perspectives of both landlord and tenant and some of the theory and motivations of each of those parties that are participating in this process. Later during this presentation, we're also going to talk about some very broad strategies that both tenants and landlords should consider when reviewing and issuing their annual expense reconciliations. If you're on the landlord side of this process, these are things that you should know and consider so that you can formulate your approach in dealing with tenant lease audits. My name is Denise Hinkle, and I'm your host today. My background is a combination of accounting and commercial real estate. I'm an inactive CPA and have worked in commercial real estate and commercial real estate accounting for many years. My career has spanned most angles of the commercial real estate industry, from owner and developer to property management to service provider, and I've also worked on the tenant side. I'm currently a principal with Scribcor Global Lease Administration, and we are a firm that's dedicated to providing the best-in-class lease administration services for both domestic and global clients who have lease portfolios containing all manner of real estate and equipment assets. The format of today's presentation is intended to be very conversational, and we welcome your questions. If you'd like to submit questions along the way, feel free to send them using the Q&A button in your interface. We will have a Q&A session at the end of our presentation. However, if we cannot get to your question due to time limitations, feel free also to send us an email at events@scribcorglobal.com, and we'll respond to your question in a follow-up email. To get us started, I really would like to know from the audience here, what side of this issue that you are approaching us for. So there's going to be a poll that comes up on your screen. If you could answer this, and we'll review the results in a little bit here. Pass-through expenses are called by many different labels. As you can see them up on the screen, but it's all relatively the same concept. In summary, the landlord is incurring expenses for their building, and they are billing those expenses back through their tenant. You can see up on the screen, it's also known as CAM, or common area maintenance. Sometimes they're called project expenses. Sometimes they're called CTI, or CAM tax and insurance. And really the language and the lingo is noted in your lease. Your lease will have a section that says operating expenses shall include, and it'll be an entire clause dedicated to this effort. So what are pass-through expenses? Well, pass-through expenses, like I said, are costs that are incurred by a landlord that are allocated and rebilled back to a tenant per the provisions of the lease. As we saw in the previous screen, they're also known by many other different names, and they can include some or all of the following expenses. It can be called repairs and maintenance items, or things such as security, repairs and maintenance, repairing light bulbs, repairing holes in walls, painting, and other miscellaneous items to keep the property in operating condition. It can also include utilities in some cases, insurance in some cases, real estate taxes, provided that that's not a completely separate clause in your lease, and other certain allowable capital items. The bill back of a commercial expenses in commercial buildings is a somewhat simple calculation process, but it can involve some very complex issues. It's definitely an area of lease administration that is often overlooked and not typically given the attention that it deserves. The language that addresses this concept is some of the most highly negotiated, yes, least verified portion of the lease document post-transaction. So a lot of time and effort is spent up front in determining what is included and what is not included in this operating expense concept. And today we're going to aim to present both sides of the coin, the theories and the motivations of both landlords and tenants. So the agnostic theory behind expense billbacks is that tenants are consuming services that if they were the sole occupant, they would be paying for directly and fully to their landlord. Items such as cleaning, snow removal, security, utilities. If you were a sole occupant in a building, in a standalone building, not a multi-tenant building, you would be paying for these or contracting for these services directly with the providers. This is different and distinguished from the payment of base rent, which in essence is a payment for the use of that asset or the use of that physical space, the building and the property. And when you have multi-tenant properties, tenants are sharing in the use of common areas, such as lobbies, parking lots, amenities, and perhaps even utility closets where they're running wiring for internet, for phone systems and other utilities and systems within a building. And landlords need to be able to equitably allocate those common area expenses for those areas that are used in common. So let's take a look at this poll here for a minute. And we can see that a lot of people, and a pretty good split. We have a couple of landlords on the line here, several tenants and several service providers, and a few that fall into that other category. Let's talk about a bit about the intent of the process. The intent of the process is that each tenant will pay their equitable share of those costs incurred by the landlord. So it's intended to be a recovery of the landlord of those expenses in which they've incurred costs for operating and maintaining that building. What the intent of the process, it's not intended for the landlord to make a profit on expenses. They're supposed to recover their costs. It's also not to increase the asset value. You say, okay, well, how can this possibly increase the asset value? Well, anytime you're increasing income to a building, it affects the property's value if you're evaluating asset value based on that methodology. It's also not the intent of this process to recover the same expense twice. Once perhaps from directly billing the tenant, and a second time through this reconciliation or recovery process. It's also not to cover budget shortfalls. I have a good story for this one that I'm going to share in just a minute. And this process is not intended to fund the landlord's business, meaning the cost of actually owning and operating the partnership or the entity that owns the real estate. Let's talk a minute. Let me tell you a story about budget shortfalls. At one point in my career, this was probably the most egregious situation that I've ever come across in dealing with expense audits and expense reconciliations. Is there once was a landlord, and this landlord used to put forth to the tenant a budget at the beginning of every year and adjust their estimated expenses based on that budget. After the end of that calendar year, if this landlord happened to have extra money that they would need to credit back to the tenants, he would take a look at the capital expenditures that were typically not allowed to be passed back in the building and pad his actual results or his actual expenses going back to the tenants by a portion of that amount that he would need to otherwise credit back to the tenants, thus passing back a portion of unallowable capital as a part of his budgeted expenses. Does this happen all the time? No, I can't say that it does, but it does happen. And it's one example of an egregious methodology of the landlord trying to make a profit on his building in some not so honest ways. I want to go and switch here a little bit to the motivation. The landlord's motivation by virtue of reconciling and billing back expenses is to recover his operating costs. Obviously, that's really what the focus needs to be. It's not to make a profit. It's that the landlord should be reimbursed for the costs that they have incurred by operating or for operating that building. And after all, the landlord is also operating a business. So he wants to make profit, and how he's going to do that is really in three ways. The first is the appreciation in the property value. Similar to those of us that own homes, if you buy a property for $100,000, you certainly hope that it's going to be worth something more than that when you go to turn that around and sell that property after a period of some odd years. The second way that they're looking to make money is a return for their use of the asset, and that is what they are collecting base rent for. So to the extent that they have a highly occupied building, they're going to be recovering more base rent, which is their return for the actual physical use of that asset. And then their third motivation, and I put this in as minimize financial leakage, which means that they want to try to recover from the tenants to the extent that it's allowable per the lease as much of the operating expenses of the building as they can. Now, there's some very specific concepts in this reconciliation process that can go into and affect the landlord's ability to collect. Items such as gross up calculations, items such as being able to pass through certain capital expenditures. And it's really important for both landlords and tenants that this process be correct, because it's fair to the landlord to be able to recover what he's entitled to recover, but it's also fair to the tenant that he's not recovering more than he should. So how does this happen? How does he minimize the financial leakage on the landlord side? Well, there's some certain things that he wants to put into his lease. And this is some language that came directly out of a lease document that we've used for this purpose. And you can see in certain areas I've highlighted words or phrases that are favorable to the landlord that would allow him to recover more than just simple repairs and maintenance costs. And the first word is ownership. Anytime that you have an operating cost shall mean all costs and disbursements, yada, 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 related to ownership, it allows the landlord to pass back a portion of his costs that are related to owning the property. This clause also has the word leasing in it. Leasing typically is an ownership activity and in most cases is not allowed to be recovered from tenants. We also have redecorating. We also have language that says at landlord's option. Anytime that you see language that say at landlord's option, the landlord can pick and choose what they want to pass back in those following words or phrases. You can see towards the bottom of this slide that there's also equipment purchased. Equipment purchases are typically asset purchases and they affect the balance sheet in many cases and not necessarily the profit and loss statement or the statement of expenses. So anytime you see an asset that's being purchased, it's definitely in favorable of the landlord. This clause goes on to further describe costs and expenses incurred by landlord as owner. And that plays back into the previous slide that says that they could charge back ownership expenses. And we see that same language again in Roman numeral 14. And then in Roman numeral 15, it says all other expenses of owning, maintaining, operating, insuring, and securing the property. Okay, there is something that just came through the chat that said that they have no volume. I'm looking at Katie here. She seems to be doing okay with the volume here. Okay. I'm going to just go ahead and move on. And Beth, I apologize for technical difficulties that you're having, but I think we're doing okay on our side here. Let's flip back and talk a little bit about the motivation of the tenant. And on the flip side, the tenant is motivated to try to monitor their spending and spend, we'll say, as little as possible, but what they should as it relates to their real estate costs. They, because they're running a business, want to ensure that they're receiving their services that they've agreed to when negotiating their lease. They are entitled or they have the obligation to pay for the use of their space via the base rent. And they're also responsible for paying a fair rate for building services. The key words in that third point are fair rate. What's fair to me may not be fair to you. And in many cases, fair rates are very affected by the city or the locale that you're located in. It could be affected by the type of property that you're in, if you're in a Class A building or a Class C building, whether you're in an office building or in a retail center, if you're an enclosed mall or a strip mall, that all affects what is considered a fair rate. Because they're trying to minimize their expenses or control spending, these are the types of things that you would want to see as a tenant in your lease clause. Again, we have operating expenses shall mean the following reasonable expenses. And in this case, there's no word of owning. It says for operating and maintaining the project. That's really, as a tenant, what you would like to see in your lease to protect you from perhaps egregious chargeback of expenses. This lease also calls for expenses related to services provided for common use of the tenant. Common use of the tenant is kind of interesting. We've seen situations where common use of the tenant for things such as elevator lobbies, parking lots, sidewalks are definitely considered common areas. When it comes to locations that have limited access, such as locked parking garages that might only have access to particular tenants or a particular population, those aren't necessarily areas that are provided for the common use of the tenant. The other language that I'd like to point out in this is that in this lease, there is also a limit to the management fees, and it says that management fees shall not exceed 4% of the tenant's gross rents, which could be differentiated from 4% of the building's total gross rents. Why does that make a difference? Because if you happen to be a tenant that scored a really good deal on your gross rent or on your base rent, you could be paying below market, and thus 4% of your gross rent is going to be less than your pro rata share of 4% of the building gross rent. And this lease also talks about capital improvements. Typically, capital expenditures are allowed, in many cases, an amortized amount of that capital expenditure if that expenditure is related to reducing any cost or a cost saving measure, or it's an item that is required by the government. When we saw back in the 90s, the implementation of the ADA Act, those were required capital improvements that landlords were forced basically to incur, and the amortization of those costs was included in many leases. This lease clause goes on to give you an entire list of what's not included. And this for tenants is particularly important. If there is something that you don't want to pay for, this is the place where you want to make sure that it's noted in your lease. So in this lease, it says capital investment items, okay, except as provided in the previous clause, if it's cost saving or governmentally regulated. This also has a restriction on the salaries that can be passed back to tenants for personnel that are senior to the property manager, and it also prohibits passing back expenses that are for procuring tenants. So that would be your leasing costs. One other cost that we see that's very common, costs for procuring tenants and retaining existing tenants. One of my personal things that I like to point out is buildings and property managers are very good at trying to retain their tenants, keeping a very friendly building, and they'll often offer things like free breakfast in the lobby or free lunch in the lobby. Those are really truly marketing costs, and they're costs of trying to retain your tenancy and creating goodwill, not necessarily strictly related to the operating and repair and maintenance of your property. And therefore, in this clause, you would have language that points to that, to allows that to be excluded. This lease also excludes capital costs of improvements, replacements, additions, et cetera, and the exclusion list goes on and on. This exclusion list is primarily important if you're a tenant to make sure that you're not going to pay for those costs that you wish not to pay for. Expense billing is really a two-step process. The first step in the process is that the landlord will prepare estimated billing. So usually in December, you will see a billing if you're a tenant that changes your monthly estimated expenses. And it may or may not have a budget attached to it for what the landlord is planning to spend in the following year with regards to repairing and maintaining the expenses. And then at the end of the year, or we'll say really the end of the first quarter, somewhere around there of the following year, you'll also see pretty much the same billing, but it's based on the actual expenses of the building for the prior year. That, if you're a tenant, is when your recovery opportunity presents itself. The landlord has the ability to bill estimates based on their budget, and they can budget whatever they want. But it's not until they reconcile those expenses and present you with the actual expenses of the building that you'll have the ability to go in and start to question what the landlord is spending. Does this mean that you shouldn't look at the estimated billing? Absolutely not. I would say that if you're a tenant, estimated billings are your foreshadowing or your advance notice of what the landlord may or may not be planning in your building. If you start to see things like reskinning the building, repainting the exterior, something to do with the parking lot where they are actually repaving, striping, sealing, whatever the case may be, you would know from an expense standpoint that it's probably something that you may want to look into when that actual reconciliation comes out to make sure that it's being done or being charged back to you in accordance with your lease document. So now I want to talk about the truth about reconciling expenses. And for you landlords that are participating in the call today, this may or may not be exactly how this is being done in your organization. But for me, I've spent at least 10 years on the landlord side of this, and this is how that we were preparing these reconciliation billings. On the left-hand side here, you have the deal makers, the left side of this red line. Typically, when the lease is being negotiated and written, it's a combination of a broker on behalf of the landlord, a broker on behalf of the tenant. You have attorneys that are involved in both sides to make sure that the legal language protects their respective clients. And you may also have a property manager that's involved in this process. So those people are upfront, involved, are aware of the intent, know the intricacies and the ins and outs of what's being negotiated. In my experience, when it comes to the end of the year, you have a property accountant, and that property accountant will take expense data from the accounting records, such as a general ledger, a trial balance, the invoices, combined with the leases themselves for a particular property. And they also have to account for estimated payments. They're taking all of this data, and then what typically will happen is the accountant will create what's called an expense pool or several expense pools for a building. These expense pools are very wide categories of expenses that typically will follow the form leases that are in that building. And then they assign the building's tenants into one of several expense pools. Once the tenants are assigned to that expense pool, that property accountant will also prepare the billing. Here's where the disconnect comes. The property accountant isn't necessarily in the know or involved on the left side of the red line with the deal makers. So there's a little bit of a disconnect with regards to communication as to who's in the know about the intent and the intricacies and the negotiation of the deal, and who needs to administer this lease on the backside. And then if you further that with the property accountant may not have the skill or the expertise to be deciphering legal language or reading the legal language, or they might be a very good accountant, but might not have experience with regards to actual operation of a property. And it creates a situation that is rife for error. We'll go through a little bit of a different kind of errors. You can see a poll that's on your screen that talks about whether or not you have a lease audit process. So I'm gonna come back to this, but I'm really interested to see if you're on the tenant side, if you have a lease audit process. I'm assuming that the landlords will answer yes to this process because you're involved in actually billing back these expenses to your tenants. So this leads us for tenant side for a desktop review. So if you're a tenant, why aren't you reviewing your pass-through expenses? And I'm just going to make the assumption until I see the results of the poll that you really aren't. Why am I going to say that? Because in our experience, 90% or more of tenants never validate their pass-through expense billing, not even a desktop review. They pretty much receive an invoice from the landlord, stamp it, pass it through accounts payable, and just pay the invoice. And if you think about the previous slide, there's a great deal of effort that is invested in negotiating that lease. And I've seen lease negotiations go back and forth for a period of several weeks over that list of inclusions and exclusions about what is included and excluded from operating expenses. And because we also have a property accountant that might not have experience in building operations, that might not have skills in reading legal documents, that's given, basically a bunch of accounting records and a bunch of leases and said, here, prepare this, there's a very large potential for billing error, both from a calculation perspective in that the math probably may or may not work. There could be oversight errors just because the accountant or the property manager or things happen. And it can also be intentional error. Remember earlier when I told the story about the landlord that was passing through part of his capital budget? That's an example of intentional error. So let's take a look at the results of this poll and see where we're at. Okay, a lot of people have 65% of you have some sort of a lease audit process established, which is wonderful. That's much less than the 90% that I've seen, but I think it's a great way to get started. Let's start to take a look at, if you're on the tenant side of things, what should I be looking for? And if you're on the landlord side of this concept, I encourage you to listen along and follow along, because these are things that you probably would want to check in advance of those reconciliation billings being sent out to your tenants. The first thing that you want to take a look at is to make sure that if you're a tenant, that you're date stamping the reconciliation when it's received. Many lease audit clauses will have timing requirements as far as when that audit window opens and when that audit window closes. And those dates are based on when the tenant receives the actual invoice and reconciliation, not when it's date stamped. I know there were certain cases that I personally was involved in where we would prepare the billing and it may be dated, say, March 31st or April 1st. But for various different reasons, either there were errors in our internal review or just the sheer volume of what we were trying to prepare, we may not send that on April 1st. It may have been held for 15 days, 30 days, some period afterwards. You also need to have, if you're a tenant, a very good feel for what your definition is for operating expenses, as well as that list of inclusions and exclusions in your lease. So always, every single year, you're going to need to review that so you can make sure that you have good information from your lease when comparing or reviewing these expense statements. And then we also recommend that you trend your expenses, the building expenses, where you can see bumps in the different categories or dips in the categories year over year, as the case may be. If you see repairs and maintenance are 100,000, 103,000, 97,000, and then 200,000, that year where you're seeing the 200,000 bump is the one that you're going to want to take a little bit closer look at and understand exactly what's being included within that category. If your lease has a base year provision, you also want to make sure that you have a full accounting of those base year expenses and make sure that that base year number is consistent from year to year. You want, as a tenant, to validate all components on the face of that invoice. You need to check everything as it comes through to make sure that it agrees with the most recent amendment in your lease document. And you also, as a tenant, want to ask questions. Ask as many questions as you need so you fully understand. No question, when I was a landlord, I was much happier to have questions coming at me than have a tenant make a claim against us for something that simply wasn't true. And then you also want to recalculate, do all of the math. In many cases, these expense reconciliations are being prepared in Excel, and anybody that's used Excel knows that the minute you forget a certain cell in a sum, it's going to throw the entire calculation off. We see a lot of calculation issues in these operating expense reconciliations that we review within our firm. So let's take a look, and this is an actual reconciliation, as you can see, dated May 31, 2016. I blanked out all of the incriminating evidence, so we don't know who it's for, but this is actually one that did come through the door here. And you can see that the face of this is basically a simple letter. And the simple letter is just, here's your reconciliation, this is what you owe. We're giving you, in this case, a credit of $4,083. The one thing that this one didn't have was a date stamp, which I said it's important to do that. I don't know, because we used an old one, if May 31st, 2016 probably wasn't the date that this was received. If it was sent by regular or registered mail, at best, it was probably received 3 to 5 days after that May 31 date, but that date stamp and the date received is going to drive what the audit window is. The next page of this reconciliation has a lot of things that are circled in it. It says the lease begin date was July 8th, 2015. Well, you're going to want to make sure that that was actually the case. This is reconciling, as you can see up the very, very top line, 2015 expenses. And that July 8th start date plays into your pro rata share of the expenses. It also has a lease end date of 7/31/2025. While you're at it and you're looking at the dates in your lease, let's validate and make sure that the landlord has the correct expiration date for your lease. We also have square footages that are circled on this. That's important because the tenant square footage divided by the center square footage gets you to your pro rata share, which on the right side is the third circle down. Tenant's pro rata share 0.17 or 17.8%. Make sure that that number agrees with your lease. Some leases are written that the pro rata share is achieved via doing that calculation, and other leases might have a stated pro rata share or a deemed pro rata share. So we need to make sure that those numbers are appropriate. Hang on one second here. The next item on this that we want to take a look at is this admin fee, this concept of a 7% administrative fee. In this lease, it may or may not have a limitation or a stated administration fee. So you want to make sure that that is in agreement with your lease. And the 0.178257 number is the pro rata share, as we said earlier, but the next circle down is the tenant occupancy adjustment. That occupancy adjustment should be the number of days between July 8th, 2015 and the end of that calendar year. So you want to validate that calculation as well. The next one is the prior billing. The prior billing is the amount of estimated payments that the tenant has made against these operating expenses. And then check the math all the way down, and hopefully it will agree to this total amount due. In this case, it's a credit of $8,144. The next page, and this is really primarily important to look at, is the statement of expenses in the building. And you can see on the left-hand side, it has all the different categories. On the right-hand side at the top, if you look, it says lease version 1. Remember when I discussed that most property accountants are creating operating expense pools? This to me would indicate that this is a tenant being billed in pool number 1. Why is the pool expense important? Well, it's important because that property account is assigning you to an expense pool and is not looking at your particular lease each and every year to see what specific items that you may have negotiated specific to your lease in that list of inclusions and exclusions. He's assigning you to a pool that may or may not be 100% applicable to your situation. And that's something to look out for. The things that jump out at me on this list are the ones that I've circled. You have routine landscaping, but then you have this line called additional landscaping that's for $37,888. Okay, so what is additional landscaping? Is the landlord replacing trees? Is this new planters? Is this a refresh? We need to understand what's in that category to understand whether or not it's allowable per our lease as a tenant. And then we also have parking lot repairs and maintenance, which is differentiated from the line above, which is parking lot sweeping. So repairs and maintenance on a parking lot can be very, very expensive. If I have a almost $41,000 expense, I as a tenant want to ask the question and understand what's in that. Is that amount simply for patching, hot patching, cold patching, and repairing of potholes? Or is that a part of a larger project that could be a complete rip out and redo of the parking lot? Chances are at $41,000, it's not a complete repaving. I know that, but I do want to have a feel for whether or not that expense in particular is going to be capital in nature. After you've done all of this desktop review, then it's time to say, should I choose a full lease audit? Usually choosing a full lease audit means that something doesn't quite pass the sniff test when doing the desktop review or validating what you can without the landlord's involvement. But it's important to know that aside from reviewing that desktop and aside from the numbers, there are several things that can affect your decision on whether to go to a full audit. Number one is the observations about the property. And the important person to talk to about this would be a facility manager or some other on-site person that is in the building on a regular basis, so they can know if there was things such as recent building work. Are they working on the lobbies? Are they working on the exterior? Did they know that there was going to be some sort of a utility upgrade? Things that may have happened that somebody on-site in that building would know of. And you also want to request, what's it like to work with your landlord? Are they responsive to things like service requests or repair requests, or the toilet is overflowing and can they send somebody up right away? What is that relationship like? Because that can play into and be an indication of what may or may not be uncovered during a full lease audit. And you also want to find out if that building is for sale. Why is that important? Well, in many cases, in my experience, when buildings are for sale, landlords tend to put a lot of money into their buildings to get them ready and spiff them up and make them nice and clean and shiny and attractive to any potential buyers. Some of those costs that are related to that could be considered capital in nature, and those are the types of things that we look to identify when undergoing a full lease audit. But there's also going to be some business considerations on whether you move to this higher level, deeper dive into the operating expenses of the building. Business considerations like, is management difficult to work with? Landlords, the best thing that you can do is make sure that you are professional in all of your dealings with the tenants. If you have a building engineer or a property manager that is going out of their way to make the tenant's life a little more complicated, it's an indication to the tenant of what they might be facing when reviewing the operating expenses of the building. Another business consideration is whether or not the tenant is currently negotiating something with the landlord. If they're looking to renew their lease, if they're looking to terminate early, expand contract, or do something with their lease, it can affect the decision on whether or not it's a good idea to go to this full lease audit. In many cases, if there are current negotiations going on, we see tenants prefer not to upset the apple cart and not to go digging in and creating additional work for landlords. But there could be certain cases where they will do a lease audit in advance and then walk into negotiations saying, well, we can make this lease audit go away if you're willing to work with us in whatever we need to do with our lease. It can go both ways. So if you decide to go to this lease audit tenant, I have some guidelines for you, and I have guidelines for landlords as well on the next slide or two. And these are kind of the rules. These are the playbook. These are the rules that everybody should follow. The first rule is called just get it right. This process, if you're going to a full lease audit, should not be about sticking it to the landlord. It should be about, we just want to make sure that our expenses and what we're paying is being done in accordance with that lease document. Tenants, this is not about nickel and diming the landlord. This needs to be just about getting it right. For tenants to come in and do a full lease audit, to the extent that they have a claim, they need to be able to fully support that claim with language in their lease, such as in the lease, section 6.4A on page 6, it states that operating expenses shall not include and state your claim. To the extent that the landlord is in agreement with that, it makes it much easier when it comes to negotiating these issues if everybody is pointing and looking at the same language. The third rule is give credit where credit is due. What does that mean? Okay, if you're a tenant and you're doing a lease audit and you find something that's way in favor of the landlord and not in your court, the ethical and the right thing to do is to give the landlord credit for that amount and say, and I know this isn't always easy because tenants are, remember we said it's a business, they're looking to pay only what they're supposed to be paying. But to the extent that you see that the landlord has perhaps undercharged you, it's only fair to let the landlord take that credit against whatever issues you have in the tenant's favor. In our opinion and in our practice, what we do is we point those issues out to our clients if we're working on behalf of a tenant, and we give them the option, and it's completely their call whether they want to go back and offer that up to the landlord. But our recommendation typically is that they do so to keep this a very fair and balanced process. Rule number 4 is stick to major issues. What do I mean by that? I will tell you that for every error, immaterial error that is being done in favor of tenant, there's probably a counter minor error that's in favor of the landlord. And in general, both of those immaterial errors balance themselves out at the end of the day. So we like to choose a threshold to say if it's any less than, we can choose a percentage, we can choose a dollar amount. We don't even get in the weeds and pursue that because chances are the plus minus, you're going to wind up about even. So really try to stick to those major issues that you want to make a point and you want to negotiate. Rule number 5, remain professional. I have seen so many lease audits go sideways because it gets very heated. As a tenant, you want to pay only what you want to pay. And as a landlord, and especially as a property accountant or a property manager, it's very easy to take this personally because many of these errors are unintentional and you don't want to look bad. So it's very important to try to calm that inner voice that says that this is personal and it's an indication that you're not doing your job on the landlord side. It's really not. Again, rule number 1, we're just trying to get it right. And then the last rule for engagement is get the whole story. Get the whole story. If you are a tenant and you're going in and performing the lease audit, make sure that you have a full understanding and you have asked all the questions so you understand in full what the issue is. So many things can happen that if you would have asked one more question, it would have changed your entire perspective. For example, we had a situation when a hurricane had gone through and really decimated a building in Louisiana when a hurricane had blown through, and we saw several expenses coming through on a reconciliation billing, and we're like, look, this is an insurable event, it's an act of God, what's the deal here? And landlord kept saying, no, we need to do it. We kept saying, this is capital, this is not allowable, whatever the case may be. Well, it turned out that there were certain expenses that were covered by insurance. Insurance deductibles are usually allowable when it comes to operating expense and bill backs. And in the case that we were dealing with, what we come to find out is that not only was the landlord billing back his expenses, but he was also improving his property along the way. So those improvements were capital improvements. So while a portion of the expenses were allowable because they were related to the hurricane, a portion was not because it was a capital improvement. Had you not asked the question, we wouldn't have been able to have the whole story to know exactly where to go with it. What's the typical process of a lease audit? And I'm going to fly through this a little bit. The process for a lease audit really begins before the process. You need to understand what your rights are as a tenant. What are the timeframes? Who can perform? Make sure that the landlord is notified appropriately. You also need to be aware of who can conduct the audit. In some leases, it states that the audit needs to be performed by a CPA firm, nationally recognized, yada, yada, yada. If you're on the landlord side of this, be aware that having that provision in your lease, while you think it may protect you, in certain cases doesn't, because the certified public accounting firm that comes to do this might not have the experience in building operations or other real estate issues to be able to effectively go through this without causing you a lot of extra grief. Confidentiality agreements. If I'm doing an above board process as a tenant or on behalf of a tenant, I don't have a problem signing them. This is to protect the landlord from having tenants basically running the elevators and getting a bunch of tenants to gang up on the one particular tenant that is conducting the audit. I would highly suggest also to try to avoid the travel. It's super intrusive to a landlord to have a lease auditor sitting in their space for a couple of days, disrupting their operations. If you can do it electronically, it's always better and less impactful to everybody involved to try to be able to do it offsite. And I'm also going to say before the audit begins is understand the opposing point of view. If you're a tenant, understand where your landlord's coming from. If you're a landlord, understand where your tenant is coming from. And then really we have information request. The tenant should be sending an information request to the landlord, requesting everything that they need to take a look at to support that operating expense billing. So all the financial support, invoices, general ledgers, contracts, payroll, there's a giant list of information that's required to really do the deep dive into these expenses. And after that info request, there'll be some period of time that's going to require the landlord should give them time to do this is field work. In the field work phase of this, if you're on the landlord side of this, you want to make sure that your auditor has working space. The worst space that I've ever been put into was it was raw space. We're talking concrete walls, concrete floor, and bare light bulb. To me, I'll work anywhere, but honestly, if that's the way that I'm going to be treated by a landlord as a tenant, and I've been very open about, I'm really just trying to get this right, it's an indication perhaps that something might be hiding that they don't want me to have access to. Not saying it's the case, but it's something just to kind of keep in the back of your head. For fieldwork phase 2, landlords, please make sure that your auditors have access to the files and to the people that they need to have access to in order to conduct their work. The more forthcoming that you can be in this process, the easier it's going to be on you. And make sure as well that there's adequate time on both sides for questions and answers. Again, ask all the questions that you want. In some cases, we would follow up with an email or a subsequent conference call to address any questions that came up after we left the landlord's place of business. The third is to prepare a report. The report, and if it's done by a third party, this report will go to the tenant since the tenant is the client in this case. And the tenant forwards that report typically with a cover letter to the landlord. The report should be very factual. It should include, as we mentioned earlier, lease language to support the findings or the claims of the tenant. And it should also have a calculation that calculates down to the amount that the tenant is requesting in case of an overcharge, as well as those credits that we said could possibly go back to the landlord. And then the fourth phase of this process is what I call resolve. This is really the negotiations. Negotiations for these can take days, they can take weeks, they can take months, and I've even seen some take well over a year. It all depends upon the issues that are raised and the dollar amount really that the tenant might be looking for. The larger the dollar amount, typically the longer it will take to have the resolution of this lease audit. And sometimes it can all come down to a number. In certain cases, the tenant is going to want to try to resolve on an issue by issue basis. In other cases, it's just going to come down to a number. At the end of the day, once the negotiations are done, landlords make sure that you request some sort of a confidentiality agreement. The confidentiality agreement will prevent the tenant from either ganging up on other tenants or disclosing the resolution of this lease audit issue with anybody other than the parties that were involved. And then tenants in following years, you also want to follow up and make sure that whatever changes that you have negotiated and successfully resolved during this lease audit process are applied to future years. Especially in the case of a base year audit, those base year changes, to the extent that a base year is changed, it's going to affect every single lease year up to and including the final lease year. And you want to make sure that those changes are applied retroactively as well as prospectively. And at the end of the day, hopefully the tenant and the landlord are still going to have a good relationship. Again, as long as you keep it professional and you maintain everything in a professional and above board manner, this doesn't necessarily need to be a contentious type process. There's definitely, as we discussed here, there's a bit of an art to doing the lease audit, and there's some science that goes into it as well. But at the end of the day, it all comes back to the lease document. So we're going to have questions and answers. And the first one is coming out from Connor and says, what are your thoughts on the landlord grossing up management fees, cleaning fees to 95%? Okay, this gross up clause really, I don't have a problem with. I think it is allowing the landlord to recover, on a pro rata share of expenses, what the tenant truly would be responsible for if the building were 95% or fully occupied. I think the actual calculation of grossing up can get a little dicey in that you need to make sure that only variable costs are grossed up. Things like if you take cleaning, there's a fixed component to cleaning and there's a variable component to cleaning. The fixed component will be things like cleaning the lobby space. It's going to be cleaned whether there's one tenant there or there's 50 tenants in your building. But places such as like bathrooms or cleaning on vacant floors, yeah, you're not going to be cleaning vacant floors to the same extent or the same cadence perhaps as you would be cleaning only your occupied floors. So I think the concept in itself is a good one. I think the calculation and how you get to that number is where you really need to question. Second question says, we are seeing in many leases that the building is less than 95% full. The landlord is actually making a profit on their pass-through. Well, if you're just talking about the dollars, that might be somewhat true, but the landlord is also taking that risk with regards to the vacancy in their building. So really, especially in the cases where base years, as long as you're comparing the same basket of services or you have that same methodology for grossing up in your initial year as you do in every comparison year, it truly is a fair method for a landlord to uncover his expenses, even if he's grossing up. Now, you do have more room in cases where there is a high level of vacancy in a building. I think there is the opportunity for a very in-depth discussion about what constitutes expenses that are 95% occupied. And you really have to look at pretty much each individual line item and go into the service contracts and say, look, this cleaning for this area is going to be done whether I'm the only tenant or if I'm one of a fully occupied building. The same goes for trash. The same goes for paper products. The same goes for utilities. Utilities for parking lot lights have no effect or are not affected by the occupancy of the building. Next question we have, what is the largest recovery you've ever seen from an individual lease audit? This is a great story. There was a tenant, it was prior to my joining Scriptcore, that I had performed a lease audit for. It was an office tenant in Houston, Texas. So if you're in Houston, I hope this isn't your building. The tenant had 80,000 square feet of office space in a multi-tenant office park situation. There was a base year issue. and there was a definition of operating expenses issue. And in this particular case, the lease said operating expenses shall include, and gives the entire list of what can be included. And that also included real estate taxes. Real estate taxes were included in the definition of operating expenses. And in this case, this lease also had a base year. So when we evaluated the base year and included the operating expenses, we successfully negotiated a life of lease savings of $6.4 million for the tenant. That wasn't all in credits coming directly back to the tenant, but over the life of the lease, it was $6.4 million. Are there any other questions? Okay, there are no other questions. As you can see, my contact information is up on the board. Feel free to screenshot this, send me an email if something comes up, or if you have questions over the next couple of days, or if we can help you in any manner on dealing with this issue or dealing with specifics of what you're facing. I encourage you to follow us on social media. You can find us on LinkedIn, you can find us on Twitter, and you can find us on Facebook. And it's the best way to stay up to date with what's going on in lease administration and to be on our list for future presentations. If you have any suggestions about content you'd like to see us cover, feel free to shoot us an email, either in my contact information, and I'll put it back up on the screen here, or email us at events@scriptcoreglobal.com. Thank you very much for participating today. We look forward to hearing from you soon. Have a great afternoon.